Hello everybody, my name is Alash Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I would like to go over a few mistakes I find people make when they're investing. These are in no particular order, with some overlap possible. The first mistake is not having a plan. So you should have an investing thesis to check your investments against, or have an asset allocation set out. So for example, you might want to consider 10% Canadian stocks, 30% US stocks, 30% developed world stocks, and 20% emerging market stocks, 10% bonds, and have all of this written down, posted on your fridge somewhere. If you are going into individual stocks, you can have rules such as Peter Lynch's rules, which use some quantitative value criteria for stocks. This is only when you're doing individual stocks. So the first rule he had was trading below intrinsic value, defined as the price that the investor would be prepared to pay for the security if it were not listed on a public stock exchange. So this is how much are you willing to pay for the business. Second rule he had was trading below book value, preferably below net working capital less long-term debt. Third rule he had was a company must be profitable, ideally having increased its earnings for the past 5 years, and be dividend paying, ideally with a regularly increasing dividend. Fourth rule was the price had to be less than half its former high and preferably near its all-time low. And the fifth rule that Peter Lynch had was that the PE had to be less than 10 in single digits. So have a plan when you're investing, have some rules in place. Mistake number 2 is not automating their investing. You should use dollar cost averaging to buy investments for the same dollar amount every month as you make the money at work. It's the simplest thing, and it's a nice forced savings plan. The third mistake is investing with emotion. So that could be greed, it could be fear, it could be FOMO, or fear of missing out, or TINA, there is no alternative. People who invest with emotion, whether they're buying or selling, are doing it for the wrong reason. There's a famous quote, "No one ever made money panicking," when you're selling out of fear. Similarly, buying out of greed at the top because you're feeling like you're missing out, also known as FOMO, and everybody else is making money, is also a bad idea. Feelings of TINA, there's no alternative, and you are forced to invest, doesn't end well either. Follow the plan, invest automatically, and if you're using individual stocks, have a plan of when you're getting in, when you're getting out, what happens when the stock goes up, what happens if the stock goes down, and have stop losses in place to prevent you from losing too much money if you are wrong. Mistake number 4 is jumping on the bandwagon, usually when all the money has been made. So buying near the top because you believe the stock price will continue to rise forever is a problem. Hearing about the stock at the water cooler where a coworker is mostly bragging about how much money they made is the best way to get in at the top and lose a whole bunch of money. You want the stock that took a tumble but will recover, or isn't known to the market yet, so you get in at the bottom. Mistake number 5, not understanding the investment. Invest only in companies and investments you understand and could explain their business model to a 10-year-old, or could write it down on a 3x5 card as to why it is a good investment. People often mistake a complicated investment for a sophisticated one, and they are not the same thing. Mistake number 6, trading or having too much activity. Trading too frequently, especially if you're being a day trader, is not how money is made. Being too active and trying to outguess the market is gambling, and only your brokerage will make money off the trading commissions. Don't jump in and out of positions, or if you feel you'll make money that way, do it with a small percentage of your portfolio, and with a brokerage that charges no commissions ideally. If you do feel like gambling, at least follow these rules. Limit your losses to your principal. Do not sell calls on stocks you don't own, for instance. Be prepared to lose 100% of your investment. And lastly, choose and stick to a predetermined limit to determine when you will walk away, just like at the casino. Mistake number 7, trying to time the market. As the cliche goes, time in the market is more important than timing the market. No one knows for sure where the market tops or bottoms are, so just keep investing. Don't guess at where the bottoms are to put your money in. All we know for sure that over time the market goes up. I have resigned myself to reacting after the market has gone down a bunch and putting more money in then. I refuse to sell off my portfolio on a hunch that the market will go down. No investor is successful at timing the market, no matter how optimistic they may feel about being able to do it. It turns out most of your returns are determined by asset allocation, that is, whether you choose to invest in stocks, bonds, or whatever else you want to invest in. It's not by market timing, nor even by security selection. In fact, people are their own worst enemies, underperforming the market because they tried to time things and they missed. Nobody can do it consistently. Mistake number 8 is the lack of patience. Things don't happen quickly in an investing portfolio. Especially large companies don't double in price in a month. Investing takes years, not days. Speculation or gambling can happen quicker, but it also has greater risks than actual investing. And I try to stay on the investing side of things. Mistake number 9, not diversifying. Some people say that diversification is the only free lunch in investing. It's easy to do if you stick to your asset allocation. If I can use a baseball metaphor, diversification will make sure that you hit singles consistently. You're unlikely to hit a home run, which would happen if you concentrated your investments, but then they would also be putting up that strikeout K for you occasionally if you concentrate your investments. So as a general rule of thumb, don't allocate more than 5 to 10% of your portfolio in any one investment. Mistake number 10, waiting to get back to even. Getting back to even is just another way to ensure you lose any profit you might have accumulated. It means that you are waiting to sell a loser until it gets back to its original cost basis. The problem is the market doesn't care how much you bought your stocks for. Behavioral finance calls this a cognitive error. By failing to realize a loss, investors are actually losing in 2 ways. First, they avoid selling a loser, which may continue to slide until it's worthless. Second, there's an opportunity cost of a better use of those investment dollars. If you want to keep a stock until it returns back to where you bought it for, think about it like this. Pretend you don't own the stock. Pretend you're going to buy it now and ask yourself whether you think it'll go up X% to where you bought your real stock. If the answer is no, why do you expect your real stock to do it? Mistake number 11, falling in love with a company. A company is an investment. Just because they did well in the past doesn't mean it will do well in the future. So make sure you evaluate all your holdings with a critical eye. And if something changed since you bought it, you may want to sell it. Also, if you wouldn't buy the company today, don't continue to hold it just because you already have it. The fact that you already own it doesn't make it a good investment and shouldn't make a difference in your evaluation. If it is not going to do well in the future, spend the $10 commission, admit you were wrong, and sell it. I dislike when experts give a buy, hold, or sell rating. It should just be buy or sell. If the company isn't worth buying, it's not worth holding. And finally, mistake number 12, not taking advantage of employer match. Employer match of an RSP or a TFSA investment you make through work is free money, period. It's just part of your compensation package. Always take advantage of it, even if the investments are at best average. A 4% return on free money is better than 8% on money that came out of your own pocket. So that's the dozen errors and mistakes that people make while investing. I hope those have been useful, and I hope you will let me know any mistakes or errors that you have come across in your investing life. Also, if you have any requests on what you would like me to cover in future videos, please put that into the comments section. Please like, subscribe, ring the notification bell, and may you have a profitable day.